2 days in a row now since midday Thursday last week. The reflation theme has woken up a little bit. 10-year yields slightly inching higher, and some participation today from cyclical groups. Ben Emons is joining us, the Global Macro Strategy Managing Director at Medley Global Advisors. Ben, good afternoon. Does this reflation trade have a chance?
Hey, Oliver, good afternoon. It may have a chance. You know, we get CPI tomorrow, and although it could surprise to the upside, right, there's still inflation building in the economy. So there's that reflation idea. We're definitely not in a deflation environment, unlike what the yield drop last week may suggest. You know, some in the market may think that, you know, we're going to slow down the economy so much that we're going to go back to really low, if not deflation. I think that the turn that we saw on Friday was a bit of the contrary, that people did say, look, we're going to get more inflation out next week. We're going to have a Fed that's going to stay on the sidelines as a result because it wants that inflation to be higher. And that's, I think, your reflation idea. So it's still in the market. I think you saw it today. The financials in particular were benefiting from this reflation idea.
Now, Ben, there's this delineation it seems that we have to make between runaway dangerous inflation, elevated, persistent inflation, or a return back to the deflationary trends. The overall consensus seems to be that the market has told us the hyperinflation is not a risk, but what about elevated inflation as being a complicating factor?
I would agree with you that that is an issue in terms of that. So on one hand, you get this base effect, right? And that's what we went through, say, April into May, into June. But then the stickiness is showing up in surveys. New York Fed survey today showed that too. Like these let's say 1-2 year inflation expectations remain really high. I think what people are doing, consumers that is that they are preparing themselves for something longer lasting than what they were used to from the past. So there is that idea that we could stay at this kind of levels of, say, 4%-5% on headline CPI for at least through this year, if not into the first half of next year. And that too leads to higher core inflation. You know, one thing we have to watch for tomorrow is this owner equivalent rent that could pick up. And, you know, there's been signs that rental prices are up again. And that too, I think, plays into people's mind that once you get that type of item picking up instead of used cars or certain necessities, you know, inflation could stay a bit higher. So I think the market has priced it in the inflation-linked market. But the yield curve, on the other hand, is showing a bit of a different sign. So elevated inflation, but flatter yield curve.
Now, Ben, a hypothetical, if we get a warmer than expected print tomorrow, what does that mean for bonds? Do we get more flattening or do we get a pop in long-term yields? What do you think we should expect if the number does come in higher than the expectations?
I would be on the side of that we would see a bit of higher long-term yields because right now we haven't really factored in, say, a series of rate hikes in the future, just one lift-off point. And we do know that if inflation stays elevated above the target, it does bring forward more the first rate hike, in addition following rate hikes. So it's not entirely reflected right now in the price. So I think if there is a real upside surprise, you could see long-term interest rates move, what you say, pop higher. What is that? Maybe 5-10 basis points, but that's in the current market environment meaningful. On the other hand, I don't think that you're going to get like a major bear steepening following through because the message that followed from Powell probably on Wednesday is about that they still look through this inflation period until they see, you know, a period where employment and inflation fall together and they can start lift off. So as long as that's the case, the market will never be surprised by any future action by the Fed, but it will discount elevated inflation means future rate hikes.
Now, one of the things you've been looking at is the rate of these data surprises versus how quickly the economists have been getting their hands around it. The data has been overall less robust compared to expectations. Last several months, we've seen the surprise indexes decline, as you can see here in the blue. What are you looking at here for the revision index, and how does that factor into what we might see going forward?
Really interesting, the economy going on here, Oliver, because Yes, the surprises are out of the data. That is that whole base effect, the statistical aspect of the data. And then I think just some, simply somewhat slowdown in the momentum of the data that we saw. But the revisions have been consistently higher, almost every number that came out. And that does show that there's underlying strength there. Meaning, a revision happens when a data point comes out, and then the following month it's revised through the statistical process, right, higher. But it shows a consistency. And I think why we're seeing this is that, okay, we may not have any data surprise just yet, or until maybe this week, because now the base effects are out of the way, so the data is cleaner, so we could see a surprise. At the same time, there's underlying strength. So I do think that markets are paying attention to this in the sense that what we really went through over the last, say, month and a half was essentially a cooling of the economy. We got just a bit overheated. And while the revision index shows that we're actually having consistent strength. So I do think that the third quarter will be a really good quarter still, maybe not 10-15% real GDP, but definitely something in the range of 6 to 8% real GDP.
All right, so we're still looking at good numbers on the economy and the role of inflation. We'll get an update tomorrow. But the positioning, Ben, looks to be a little bit more obvious, perhaps, or a little bit more kind of skewed. You're looking at the 10-year future put to call ratio, or rather call put skew. So as this line goes higher, you've got more bulls positioned in the bond market. What's interesting is it is fairly decently aligned here with some of the skew data that looks at investors buying up out of the money protection. Walk me through this relationship.
Yeah, so if you look at this, right, so the bond market has a skew that suggests that it is now cheaper to buy options to protect yourself against rates to the upside, whereas when you buy options to protect yourself against rates going even lower, it's more expensive. And in the stock market, it's exactly the opposite, right? You have the skew pointing to put options on the S&P being quite expensive at the moment relative to calls. So I think what this picture says is that we have really low rates. It is a function of this pandemic. It overhangs, I think, the bond market with all this uncertainty, the Delta variant, and that people are still looking at the pandemic saying we're not out of it yet. We have a strong economy, but we could get like uncertainty coming back. Why people are looking at more downside in rates and buy options, I guess, to protect themselves against lower rates, so to speak. And then you have the opposite in the equity market being really bullish, but the higher you get with the S&P, so today we're hitting again new highs on the Dow and the S&P and the Nasdaq. People continue to want to have some sort of downside protection. The two come together because in the end of the day, if you have a stock bond portfolio, the bond side still matters quite a bit in a stock portfolio for this possible downside risk that you may experience in equities sometime in the future, were the economy to really slide further down. So I think we're at a point here where the market said probably yields are a bit on the low side, and while the stock market is still making new highs. I think that's where we're at right now.
So, Ben, is there an argument to be made that these two kind of fit along with each other, that maybe there's a little bit of caution kind of underneath the surface? A lot of people are saying bond market doesn't line up with stocks, but we know that more than half the stock market has been declining and the cyclical stuff has been underperforming. So if there are people buying far out of the money protection in stocks, I mean, I guess that could kind of go along with buying bonds if you view bonds as a risk-off play, right?
Very much, and I think that this is why we keep, I think, this very steady trend in stocks higher. If the insurance works, so to speak, in other words, bond yields continue to grind lower and they make some value on bonds while stock prices go up, then that kind of gives you a working insurance that works, so to speak. And you could mix that, I guess, with your option play on the equity side as well. If those get a bit on the expensive side, you switch a bit to bonds, right? And if those options on put options on S&P get a little cheaper again, you switch out of bonds, right? So I think it's that kind of dynamic at the moment. Obviously, we're going to get to a point where people are going to make an assessment. This economy stays strong, we stay on the right track, and it should lead to higher rates because the pandemic does moderate further and further and does become less and less of an influence on the economy itself. So it should lead to higher rates. And as that happens, those put options then on the S&P index do kick in terms of value, right? So I think this is why we keep this nirvana, if you will, an old analogy from last year, but it's, I think, back in the market, nirvana between stocks and bonds driven by insurance that's working at the moment.
Okay, so they are kind of in sync to some degree here. Ben, interesting stuff and a nice preview for us tomorrow. Thanks a lot.
Thank you. Thanks, Oliver.
You got it. Ben Emons is the Managing Director of Global Macro Strategy at Medley Global Advisors.